Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and joining me, as always, is Lizzie. It's Monday, February 2nd, 2026, and we've got a lot to unpack this morning. Markets are showing some notable volatility, especially in the tech sector, where AI-related concerns are creating headwinds. Lizzie, let's start with what's happening in the energy sector, because we're seeing some significant consolidation activity that's worth discussing.
Absolutely, Robert. The big story is Devon Energy's $58 billion all-stock merger with Coterra Energy, creating a major shale giant. This is one of those deals that really signals where we are in the energy cycle. When you see consolidation at this scale, it typically means companies are looking for operational efficiencies and cost synergies, rather than betting on massive price appreciation. It's a mature industry move, and it tells us that energy executives are focused on shareholder returns through scale, rather than aggressive expansion.
That's a solid point about the maturity of the sector. Now, shifting to technology, we're seeing some pressure on tech stocks, particularly around AI investments. Nvidia shares dropped about 2% on reports that their OpenAI investment might not be as substantial as initially expected. What's your read on this market reaction?
Well, Robert, this is where we're seeing some uncertainty creep into the AI narrative. Investors have been pricing in massive growth expectations for AI-related companies. And when you get news that suggests those investments might be smaller or more cautious than anticipated, it creates doubt. The interesting part is that Oracle announced plans to raise up to $50 billion this year to fund AI infrastructure, but their stock still dipped 3%. This tells me the market is becoming more discriminating about AI spending. It's not enough to just say you're investing in AI anymore. Investors want to see clear paths to profitability and return on investment.
Right, and we're seeing that skepticism reflected across the broader market. On a more positive note, consumer-facing companies like Disney and Tyson Foods beat earnings expectations. Disney's theme parks and streaming services performed well, which suggests consumer spending remains resilient in certain sectors. How do you interpret this divergence between tech uncertainty and consumer strength?
It's a really important divergence, Robert. What we're seeing is that consumers are still willing to spend on experiences and essentials, which is what Disney and Tyson represent. Disney's theme park strength shows people are prioritizing entertainment and family experiences, while Tyson's beat indicates food demand remains stable, despite inflationary pressures. However, Disney did see a decline in net profit due to higher costs, which is the challenge across the board. Companies can generate revenue, but margin pressure is real. This creates a mixed picture where top-line growth doesn't always translate to bottom-line improvement, and that's something investors need to watch carefully as we move through the first quarter.
Let's transition to value investing opportunities. Lizzie, what's catching your attention in terms of undervalued stocks right now?
Today I want to highlight the Cigna Group, ticker CI, which is showing some really compelling value metrics. Cigna is trading at a price-to-earnings ratio of just 12.01, which is quite attractive for a healthcare company of this size with a market cap of $73 billion. What really stands out is the forward PE of 9, suggesting analysts expect earnings growth while the stock remains cheap. The price-to-book ratio sits at 1.75, which is reasonable for the sector, and they're delivering a return on equity of 15.54%, showing management is effectively using shareholder capital. They're also paying a 2.2% dividend yield, so you're getting paid to wait. But here's the kicker, Robert. The PEG ratio is just 0.07, which is exceptionally low, and suggests the stock is significantly undervalued relative to its growth prospects.
That PEG ratio is particularly interesting. For our listeners, a PEG ratio under 1 is generally considered attractive, so 0.07 is quite notable. What's the investment thesis here for Cigna?
The thesis is straightforward. Healthcare services remain essential regardless of economic conditions, giving Cigna defensive characteristics. With an aging population and continued demand for health insurance and pharmacy benefit management services, the revenue stream is relatively predictable. The company has a reasonable debt-to-equity ratio of 81, which is manageable for this industry, and the profit margin of 2.29%, while modest, is consistent with the healthcare services model, where volume matters more than per-unit margins. What makes this a value opportunity is that the market seems to be underappreciating the stability and growth potential. At a 12 POE, with expectations of continued earnings growth, there's significant room for multiple expansion if the market recognises the quality of this business.
Now let's look at our stock of the day. What are you focusing on?
Today we're analysing JD Sports Fashion, ticker JD.L, which is a UK-based multi-channel retailer specialising in branded sports fashion and athletic footwear. Currently trading at $84.14, this stock has had a challenging year, down about 1% over the past 12 months and down 1.84% year to date. But here's what makes it interesting, Robert. The company operates through three main segments: JD, complementary concepts, and sporting goods and outdoors, with a strong international presence across the UK, Europe, North America, and Asia Pacific. They compete with brands like Foot Locker and Dick's Sporting Goods in the premium athletic and streetwear market. The stock has been trading in a wide range, from a 52-week low of $61 to a high of $106, and it's currently sitting about 21% below that high.
What's driving the weakness we've seen over the past year?
The modest decline reflects headwinds common across the apparel retail sector. We're talking about consumer spending pressure amid inflation and cost of living concerns, particularly in the UK and Europe. There's also been competitive pressure in the athletic footwear and apparel market, with brands increasingly going direct to consumer and bypassing traditional retailers. Inventory management has been challenging across the sector as well. However, the fact that the stock is only down about 1% over a full year shows underlying business stability. They've managed to navigate a difficult environment without catastrophic losses, which speaks to the strength of their market position and brand relationships.
What about the current valuation? Is there an opportunity here?
This is where it gets really interesting, Robert. The stock is trading at a PE ratio of just 8.41, which is remarkably low for a retail growth company. Apparel retailers typically trade at 12 to 20 times earnings, so JD Sports appears to be trading at a 30 to 50% discount on an earnings basis. The forward PE is even lower at 7.27, which tells us analysts expect earnings growth of about 15 to 16% year over year. 16 analysts have a strong buy recommendation with a consensus target price of $106.48, representing 26.5% upside from current levels. The risk-reward appears favourable here, with downside to the 52-week low at about 27% versus upside to target of 26.5%. But analyst conviction suggests the asymmetry favours the upside.
What should investors watch going forward with JD Sports?
The key opportunities include a valuation re-rating, as the current 8.41 PE offers substantial room for multiple expansion towards sector averages. Their international expansion, particularly in North America and Asia Pacific, provides diversification and growth runway. As a category leader, they're positioned to capture market share from struggling competitors. On the risk side, as a discretionary retailer, they're vulnerable to economic slowdown and reduced consumer confidence. The athletic apparel sector still faces inventory normalization challenges, and their international operations create foreign exchange headwinds. But if consumer spending stabilizes and the company demonstrates stable earnings, that year-end target of $106 looks achievable, which would represent a full recovery to near the 52-week high.
Let's wrap up with crypto markets. What's the sentiment looking like for the week ahead?
Robert, I have to be honest. The crypto outlook is predominantly bearish across the board right now. Bitcoin is facing significant pressure with a 72% probability on Polymarket that it slips below $65,000. We saw a brutal sell-off over the weekend that wiped out $290 billion in market cap, with Bitcoin briefly falling near 74,000. The technical indicators are mirroring past bear market patterns, and we had a $2 billion liquidation event that pushed Bitcoin below Strategy's cost basis of 76,000. Average Bitcoin ETF buyers are now underwater, with investors pulling $2.8 billion over 2 weeks, suggesting potential capitulation. Ethereum is similarly bearish, with treasury firms like Bitmine facing nearly $6 billion in unrealized losses from the Ether downturn. Solana dropped to April 2025 lows and suffered a security breach at Step Finance that resulted in a 90% crash in the Step token, draining $27 million in SOL from treasury wallets.
What about institutional versus retail positioning in Bitcoin?
That's a critical question right now. We're seeing interesting divergence. On the institutional side, Binance announced plans to buy $1 billion worth of Bitcoin for their user protection fund and already made their first $100 million purchase, and Justin Sun bought $100 million during the sell-off. Michael Saylor's strategy added $75 million in Bitcoin before the crash, though they're now sitting on paper losses. However, Bitcoin ETF holders are showing signs of capitulation with significant outflows and paper losses mounting. The retail sentiment appears quite negative, with thin liquidity keeping traders on edge and weekend volatility exposing the market's fragility. The key factors to watch this week are whether Bitcoin can hold support at 74,000, ongoing minor disruptions from the US winter storm that affected production, and whether we see further institutional buying or if ETF outflows accelerate. The overall sentiment is bearish, and this week could determine whether we're in for a deeper correction or if these institutional purchases provide a floor.
Well, that's a comprehensive look at the markets this Monday morning. To summarize, we're seeing consolidation in energy with the Devon-Katerra merger, uncertainty weighing on AI-related tech stocks despite continued investment, resilient consumer spending in select sectors, value opportunities in healthcare with Signia, a potential contrarian play in JD Sports fashion trading at significant discounts to historical multiples, and bearish sentiment dominating crypto markets with key support levels being tested. As always, these are complex markets with multiple crosscurrents. Remember, do your own research and consult with financial advisors before making investment decisions. Thanks for joining us on The Morning Bell. I'm Robert, and we'll be back tomorrow with more market insights. Have a productive trading day.